All right, here we go. Specific identification, the first one that we're going to talk about. And as the name implies, we're specifically identifying which inventory has been sold, which one is leaving, and which ones we can expense. We know exactly how much they cost because it's specifically identified. So, how does this one work? And typically we call this SI. This usually is only practical for businesses that have high price, low turnover inventory. If you're talking about a business that sells a lot of the same goods, this is really hard to do because if I sell them a lot over a given amount of time, I don't know exactly which one I sold. However, if I'm like a car dealership, I know exactly what car I sold. I know exactly how much it cost me, so I can know exactly how much to expense it with. If I'm doing it for fruit, I don't know which batch of the fruit it came from, so I don't know exactly which one I can expense. I would have to use an assumption for that one. But SI is very specific, obviously like the name implies. What this one does, conceptually what it does, is as the sales occur, COGS, cost of goods sold, is charged with the actual or invoice cost, leaving the actual cost of inventory on hand still in the inventory account. So what I sold is actually the number that it cost me. That's what I expensed. And then what I still have in my warehouse is the actual number of what I still have because I know exactly which ones they are. Now for me, when I learned this, it made way more sense to me when I saw it visually. I wanted to see things move. So that's what I'm going to show you kind of, hopefully this will make a little bit more sense to you with SI. So let's look at a quick example right now. We're not going to go through the whole process, but I want you to see what this means, what we're dealing with conceptually. So here's our warehouse. We're a Delta company, and we have all these things. We have some inventory that we're selling for $25. It cost us $25 a piece to bring them in, and that we had that in our the beginning inventory. And then we bought some more on April 15th for $27 a piece. And then we bought some more on October 13th for $30 a piece. Okay, so what's in our warehouse is what we have available to sell. Now let's read the problem. It says, assume that Delta Company sold 29 units. So we know we sold 29 units, but here's where SI comes into play. Of which 6 units came from the inventory that was already in the warehouse at the beginning of the year. 12 came from the inventory purchased on April 15th, and 11 came from the inventory purchased on October 13th. That's a typo. That right there lets me know that I can do specific identification. Without that information, I couldn't because there's no specific identity of where these came from. So basically what we're saying is I sold 29 units and I know exactly where they came from. Of that, 6 of them came from the ones that I had in January 1st. So I'm going to take 6 out of my warehouse and give them to the person that bought them. And then on the April 15th one, I'm going to take 12 of those and I'm going to give them to the person that bought them. And of the April 13th one, I'm going to take 11 of those and give them to the person that bought them. So now everything in my warehouse is what I have still available. That's my ending inventory balance. Everything outside the warehouse is what my COGS is because I've sold those. Therefore, I need to expense them. And that's how you do conceptually specific identification. In the actual next video, you're going to see the example of specific identification. Appreciate it.